Good morning, students. In our previous sessions, we were discussing about the methods involved in computing cost of debt as a source of finance. More specifically, the cost of a debenture or a bond. Help you to understand the method of computing cost of debt for perpetual debt. In case of cost of perpetual debt, the cost of debt before tax is its coupon rate of interest. So perpetual debt means it is irredeemable. Only the firm will pay the interest. The principal amount will not be redeemed. So it is irredeemable. Irredeemable. Redeemable means the principal amount to be redeemed, repaid after the committed time period. When a firm has raised its capital by issue of debentures for 5 years or 7 years, the principal amount is to be redeemed after 5 or 7 years. If it is along with the interest, the committed coupon rate of interest, year on year basis, interest will be paid, but the principal amount will not be redeemed. This is the nature of the character of this kind of debt, this perpetual. In such case, the before tax cost of debt is the coupon rate of interest, which is calculated using this equation. Ki, which is before tax cost of debt, is equal to interest, the annual interest payment, divided by sale proceeds of the bond, or net proceeds of the bond, or amount realized by issue of bond. Whereas the effective cost of debt is the tax adjusted rate of interest. In that case, the effective cost of debt is to be calculated using this equation. Here it is denoted as KD, that is cost of debt tax adjusted. So using the same formula, interest, annual interest payment divided by sale proceeds multiplied by 1 minus tax rate. T is nothing but tax rate. Let us now consider this question. A company has 10% perpetual bond or perpetual debt of rupees 1 lakh. The tax rate is 35%. And you are asked to determine the cost of capital before and after tax, assuming that the debt was issued at par, at 10% discount, and at 10% premium. At par means it is face value, at face value. What is face value here? Face value is not deliberated in the question. At par means face value. Normally, unless otherwise given, in the normal circumstance, face value can be considered as rupees 100 in the normal circumstance, as rupees 100. Or we can calculate using the total amount itself. The company is planning to raise rupees 1 lakh at 10% means, so 10% of 1 lakh will be rupees 10,000. That means for your annual interest commitment of 10,000, you have raised rupees 1 lakh. So this 10,000 is your annual interest payment. So answering to the first question, debt issued at par. So KI is equal to 10,000 divided by 1 lakh. Nothing but 10%. A coupon rate itself is the cost. And KD, which is tax adjusted effective cost of debt, will be 10% into 1 minus tax rate is 0.35. So it will be 6.5%. So in such case it will be 6.5%. So out of 1 rupee, 35 paisa will go to tax. The balance will be 65 paisa or 0.65 multiplied by 10%. Nothing but 6.5%. So this is your effective cost of debt after tax. Because this 35% is a tax deductible. This can be debited and claimed as business expense, and it can be charged in the profit and loss account, by doing which your tax burden will get reduced. And because of which, the effective cost of debt has declined from 10% to 6.5%. This is with regard to debt issued at par. If it is issued at 10% discount, means what? If your issue size is rupees 1 lakh, from this you offer a discount so less discount at 10%. So your realizable value, net proceeds, or here in the formula it is called SV, sales value, sale value, or net proceeds will be equal to only 90,000. But your interest commitment will be 10% on 1 lakh. You have to pay annually interest at the rate of 10,000 for a net proceeds of 90,000. In that case, the KI, that is before tax cost of debt, will be I, which is 10,000, divided by SV, which is 90,000. 90,000 is the net profits because you issue debt at 10% discount. That means the issue size is 1 lakh, out of which you are allowing a discount of 10%. That means your collection, the amount realized will be rupees 90,000. So this is I that is annual interest payment, and this is your sale value or realizable value. So in that case, the cost of debt will be 11.11%. You can calculate it. This is before tax. And tax adjusted effective cost of debt will be 11.11 into 1 minus tax rate 0.35. In that case, it will be 7.22%. So when you simplify this, you get 7.22%. And in the third case, where it was issued at 10% premium, so here your proceeds will be like this. If your issue size is rupees 1 lakh, add premium, you are issuing at a premium of 10%. So 10,000. So your net proceeds or sales value will be rupees 1,10,000 for an interest commitment of 10,000, which is 10% on 1 lakh. So in that case, your pre-tax cost of debt will be 10,000 divided by 1,10,000. So by simplifying this, you would be getting 9.09% pre-tax cost of debt. And effective cost of debt after adjustment of tax will be 9.09 into 1 minus tax rate, which is 0.35. Post-tax cost of debt will be 5.91%. So this is how the cost of debt is to be calculated under circumstances where the debt was issued at par and at discount and at premium. If you issue it at a discount, your cost is on the higher side. This is the maximum in all the other two cases. In all the other two cases, comparing with the other two cases where the debenture is issued at par, it is 6.5%. If it is issued at premium, it is only 5.91, close to 6%. Hope you are able to understand the calculation of cost of debt issued at par and at discount and premium. Thank you.